I am going to break down exactly what I am seeing in the silver markets right now, because the price action we have witnessed either ecantly is not just standard volatility. When I watched silver touch what looked like an all-time high around the 64 mark on December 11th, only to see it plummet back down to early 62, 70 in a span of just 12 hours, it knew immediately that we needed to have a serious conversation about this. I want to be very clear with you. This drop wasn't just your garden variety market correction or a simple dip. From where I am sitting, it looks like something much bigger, something far more significant, is churning beneath the surface of this price movements. I've been digging into their reports, and the data suggests that the silver vaults at the COMEX are being drained at a pace that I can not only describe as unusually accelerated. We're not talking about asm altic indem, and some analysts are running the numbers and estimating that with H-draw walls rate happening around 145 times faster than the typical patterns we have seen throughout the rest of 2024. If we see the set trends continue at this current velocity, industry observers, people who watch this for a living, are raising valid concerns that we could recheck critically. Low levels of registered ounces potentially as soon as late January. When the physical backing for this contract T's gets this tight, my experience tells me we could be staring down the barrel of a commodity squeeze scenario that reminds me very much of the history books, specifically what happened back in 1980. In this analysis, I am going to walk you through for very specific FX key indicators that I'm personally tracking every single day. These indicators might signal exactly when this situation is going to intensify, and perhaps even more importantly for you as an investor, they could tell us when to watch out for potent TL ruler changes that could shift the entire game overnight. Let me take a moment to really paint the picture of what reportedly went down between December 4th and December 8th, because the numbers are staggering. If you look at the publicly available data from the COMEX, it appears that the registered inventory, that is the metal available for delivery, dropped from approximately 48 million ounces all the way down to roughly 19 million ounces. That looks like a massive drain of 29 million ounces happening in just 4 business days. To put this massive move into perspective for Ryo, when we look at normal daily drains in 2024, we're usually tracking somewhere around 20 per hour ounces. This recent movement is roughly 145 times that normal rate. I want you to imagine you are trying to drain an Olympic-sized swimming pool, but instead of using a regular garden hose, like you normally would, you have suddenly switched to a high-pressure fire hose. That is the difference in magnitude we're the L king about here. You might be asking, why does this matter to me personally? It matters because registered inventory represents the actual L, physical silver that exists to back up the futures contracts. When short sellers get to the point where they need to deliver actual metal to settle their contracts, they have to pull from this specific register red inventory pool. When that inventory vanishes at this kind of breakneck speed, it creates a very specific market condition ka lead delivery squeeze. We have the December contract expiration approaching fast. And when I look at the current numbers, it is becoming clear that there may not be no physical metal left in the system to satisfy all he deliver our requests at these current price levels. The math is simply starting to look strained. But there is the thing that I think the mainstream financial analysts on TV are completely overlooking. This movement does not appear to be driven primarily by ale investors like you am buying up physical coins at the local shop. According to the publicly available filings from the iShares and Silver Trust, their holdings reportedly jumped by approximately $409 just in the very first week of December. That reached what appears to be their highest level since early 2021. Me, that suggests institutional capitalists flow wing into this market data significant scale. Furthermore, when I personally sat down and analyzed Theo patience flow data from December 9th through the 11th, I noticed a heavy call buying activity specific. I call it the 65 and 70 strike prices, with expirations set for January as in February 2026. This pattern suggests to me that someone out there, with substantial capitalist positioning, themselves for meaningfully higher prices within the next 60 days. And then we have to talk about JP Morgan. According to their most recent commodities desk report, which was dated November 26th, they have apparently flipped their position. They have gone from being net short to net long on silver futures, and this is reportedly for the first time in 2018, when one of Wall Street's absolutely largest commodity trading desks reverses their position like this. In my view, that is a signal that is worth paying very closely attention to. I need to make an important disclaimer here. I am not a financial advisor, this is not financial advice, and I am not affiliated with anyone owning in this analysis. This is purely my educational interpretati based on publicly available information. You should always do your own research and consult with qualified professionals before you make any investment decisions. Now, we get at the critical part of this breakdown. There are 4 specific indicators that are telling me everything I need to understand about what might happen next in this market. I am tracking this personally on a daily basis, and the moment we hit what I consider to be critical thresholds, you will know exactly which scenario could be unfolding. Indicator number 1 is the COMEX registered inventory. Currently, as of December 11th, it is sitting at approximately 1 million ounces according to the CME data. Here is my interpretation of that number. If this falls below 15 million ounces, we are potentially entering what I would call unprecedented shortage territory. If it drops below 10 million, that would suggest a possible complete mark at strain. The threshold I am watching closely is sustained at levels under 20 million, which suggests to me that this tight conditions may persist TE. You can actually verify this yourself. Just go to the CME Group website and look under are their precious metals vault reports. They updated this every business day around 4 p.m. Eastern Time. I personally check this every Monday and Thursday at a minimum, and I check it daily during contract expiration weeks. Indicator number 2 is the silver Liserat S4O in a month duration. The latest reading I am seeing is approximately 8% annualized as of December 12th. This metric is crucial because it measures the physical silver, which historically spikes when the actual metal becomes scarce. In my analysis, readings that go above 50% suggest extreme tightness in the market. We have apparently seen this threshold exceeded only 3 times as in the past 20 years. Was it in September 2008 during the financial crisis, again in March 2020 during the pandemic. Lockdowns and brief lie in October 2025. Each of those times reportedly preceded major rallies. If this rate drops below 20%, that would signal to me that the squeeze is easing. You can track this on websites like Kitco, Comeron, Bloomberg terminals. Indicator number 3 is the backward ratio and spread between the spot price and 3-month futures. The current spread I am observing is approximately 40 cents, with spot around 63. 74 and March futures, truly 64.14. In a normal, healthy market, futures should theoretically trade a TAPRI of 1 to 1.50 for a 3-month contract to account for the carrying costs, so folding the metal. When the spot price exceeds the futures price, that is called backwardation, and it signals that immediate demand may be outpacing future expectation S. Based on historical patterns, I have studied if we see sustained backwardation where the spot price trades above 3-month futures for more than 5 trading day S. This has historically preceded significant price movements within 30 days. You can calculate this yourself using spot prices from Kitco and the March futures data from CME. Indicator number 4 is the Shanghai Gold E. Its exchanges silver premiums relative to the London spot price. The current premium I am tracking is approximately 6.2% as of December 12th in overnight trading. During genuine physical shortages, Asian premiums typically expand as manufacturers compete for immediate supply. I view premiums above 2% sustained for a week as a signal of stress. Reports suggest we saw really 5% premiums brief lie back in late November. If premiums turn negative, meaning Shanghai trades below London, that could suggest China is actually selling G into Western markets, which I would interpret as bearish. You can access this data through Kitco's Asia market section or Bloomberg. I want you to watch what happens when the CFO, your indicators potentially align. If we see all 4 confirming tightness simultaneously, inventory under 20 million, lease rates above 40%, sustained backwardation, and Shanghai premiums above 1%, that is a powerful signal. According to my research, that combination has occurred only twice in motor markets, in 2008 and 2020. Both times, silver reportedly rallied over 40% within 6 months. If we see 3 of the 4 confirming, I would interpret that as suggesting a measured rally. If 2 of 4 confirm, it suggests choppy trading in my view. If only Ono or Noni confirm, that would favor a correction scenario. So what happens next? I have personally modeled 3 scenarios B acid on. Historical commodity, squeeze precedents F, rum palladium in 2020, nickel in 2022, and silver's own historical patterns. Scenario 1 is the parabolic squeeze. My estimated probability for thesis struggle worked 30% in this scenario. Silver could potentially reach or TTS to a 95 by June 2026. The catalyst here would likely be COMEX released, where the inventory falling below 20 million ounces combined with a major industrial buy or attempting to secure a multi-year supply. We would see this potentially confirmed by a silver release or rate exceeding 50%. Annualized and backwardation expanding beyond 90 days across the futures curve. The historical parallel I am drawing here is palladium in February of 2020, when a supply squeeze reportedly drove prices for around 1,500 to approximately 2,800 in just 8 weeks. If we say 3 consecutive weeks of Invento, Rydros exceeding 2 million ounces, or if Shanghai premiums widen beyond 5% of London spot, I would Consider that we're likely in this scenario. Therisk, even in this bullish case, eyes a potential rule of change by the COMEX allowing cash settlement or emergency inventory deposits from central banks. Something similar happened with Nikkei, the London Metal Exchange, in March 2022, reportedly crashing prices overnight despite genuine physical shortages. Scenario twist the measure drawly. My estimated probability, here's a proxima tally, 50%, making this my personal base case. In this path, silver potentially reaches 70 to 75 by March 2026, and then it consolidates between 65 and 80 through the year end. The December contract expiration might see some short covering, possibly pushing prices to around 72 by late December. Profit taking and new mine supply announcements could create a pullback to early 68 in January. Renewed? ETF inflows and lower real yields might drive hit the next leg to approximately 75 by March. From there, I would expect choppy trading as the market debates whether industrial demand can sustain the sale of at 80 prices. The key confirmation signals. I am watching are sustained trading above 65 with inventory stabilizing around 95 to 30 million ounces. The timeline checkpoint to watch is the January COMEX contract expiration. If we need to see significant delivery stress there, in my view, this measured path becomes more likely. Scenario 3 is the correction Anderset. My estimated probability is around 20%. In this scenario, silver peaks between 68 and 72 in the next 30 days, then potentially corrects back to 52 to 58 by the second quarter of 2026 before establishing a new trading range. The catalyst, there could be disappointing industrial demand data from China or substitution uncements from major solar manufacturers. We would potentially see this signaled by Shanghai premiums collapsing below London spot or Baileysrat is falling back under 90%. The risk factor most likely to trigger this in my anal, I see as a hawkish Federal Reserve pivot if inflation proves thicker than expected. If the Fed pauses rate cuts or signals potential hikes, real yields could turn positive again, and precious metals typically correct sharply in such environments. What would change my analysis? If I see 3 consecutive months of Finister Isola demand declining year over year, or registered inventory stabilizing above 40 million ounces, that would suggest to me that the squeeze, the thesis breaking down. The key warnings I am watching is the gold to silver ratio, which is currently around 68. If this ratio expands back above 75, it typically signals that silver may be overextended relative to gold and potentially due for AM and reversion. But there is the provocative question that I think nobody is asking loudly enough. If COMEX inventory continues depleting at even half their pace, we could theoretically hit 0 registered ounces B by late January. What happens then? In my view, the exchange either needs to incentivize any positive physical metal through higher prices, or they might change the rules to allow cash settlement. Both scenarios could be extremely bullish for spot prices, but through different mechanisms. Back in 1980, the Hunt brothers cornered the market and Oliver hit approximately 49 until the COMEX changed the rules overnight. GHT today feels different to me. Major institutions appear to be positioned longside retail. If the exchange change rules this time, they might be contending with JP Morgan and other large players, not just 2 individual traders. It is the same supply, squeeze mechanics, but this time the largest market participants might be on the same side as retail. In my opinion, that changes the game entirely. The fundamentals support this thesis. The Silver Institute S2025 World Silver Survey reportedly projects a deficit of approxima tell 170 million ounces for this year alone. That would be the 5th consecutive year of deficits, with cumulative shortfall now exceeding an estimated 600 million ounce since 2021. Mine production appears to remain relatively flat to tap rocks, immediately 103 million ounces annually. Meanwhile, industrial demand has reportedly hit record highs. Photovoltaics, that is solar panels, consumed an estimated 234 million ounces in 2025, which is up roughly 18% year over year. Electric vehicle production used approximately 78 million ounces, up around 22%. Data center infrastructure, which is the newest demand driver from the AI boom, consumed an estimated 41 million ounces, reportedly up 37% from 2024. We're not just dealing with investment flow anymore. We appear to have genuine consumption from industries that could easily substitute away from silver. Bank of America reportedly released their 65-12-month target on December 9th. That was the same day silver broke 60 for the first time in history. The report cites 3 primary drivers: narrowing real yields, increasing ETF inflows, and persistent supply deficits. But what I think they didn't emphasize enough is the backwardation signal. On December 11th, spot silver was reportedly trading around $63.25, while March 2026 futures were at approximately $63.65. That is a premium of only 40 cents for contracts sat every 3 months out in a normal market. That spread should theoretically be at least one to account for storage costs and interest rates. When I cross-referenced this with Shanghai Gold Exchange e-data, I found something I consider even more revealing. Shanghai spot premiums reportedly hit 63 on stars 23. Overnight on December 10th, briefly trading above London spot prices. This bifurcation between Asian and Western mark, it suggests to-me genuine physical tightness, not just paper speculation. The Federal Reserve's decision on December 11th adds another layer. They cut rates by 25 basis points, as expected, but the forward guidance suggested another 50 to 75 basis points of potential cuts through 2026, lower interest rates, or reduce that opportunity, cost of holding, none. Yielding assets like silver. When I calculated, there will yield in 10-year treasuries minus expected inflation, we're now at approximately negative 0.3%, historically, according to data. Haver reviewed, silver performs best when real yields are negative, averaging against SOFR around 28% per year in such environments over the past 40 years. The next major decision points I am watching are December 18th, which is the FOMC meeting, followed by December 26th, the December contract expiration on COMEX. Those are the two dates where I believe we will get clarity on which path we're taking into 2026. The bottom line from my perspective is that's keying silver around 60 with sub 20 million COMEX inventory historically significant moves, but the direction depends heavily on the next 30 days of data. I'm personally tracking these 4 indicators daily. The moment we hit what I consider critical thresholds, inventory below $15 million, lease rates above 50%, sustained backwardation.